of corporate professional and my own behalf, I extend a very warm welcome to all for the 128th webinar on business valuation, how to know your business worth. That is a voluntary valuation you are doing. Business valuation helps business owners understand the true value of their business, which is crucial for making strategic decisions about future growth. And whenever they want to go for expansion, it also enables owners to assess the financial health of their enterprise and identify the gap areas which need to be addressed. Timely value assessment and steps for making up the gaps not only facilitate to remain competitive in the market, but also to make the best use of strategic opportunity as and when they arise, because always opportunity comes without knocking your door. The process of business valuation involves analyzing a company's financial statement, market position, industry trends, and other relevant factors to estimate its potential future earnings and cash flows. This information is then used to calculate a valuation, multiple, or discount rate, which is applied to the project earning or cash flow to arrive at the estimated enterprise value. Friends, this program which we are organizing, this is in the same direction that how to assess the value of your business, what is the business worth. So today we are discussing why do we need to do valuation of a business, identify the area where valuation can be used, identifying the purpose of valuation and its impact on the value estimates, what are the main hindrances in value estimates of a business, learning the practical dimension of business valuation approaches, learning the main principle of valuation, identifying the main source of information for valuation. So these are the major area which we want to cover today and discuss. For this, I extend a very hearty welcome to all the learned speakers of today's webinar. First, Mr. Anil Kumar Sharma, Director, P&M Valuation, Corporate Professional Valuation Services Private Limited. He is a registered valuer. Then I welcome Anilji. Then Mr. Manoj Kumar, Partner and Head M&A and Transaction Corporate Professional, who interact various companies, various situations, various transactions, and in these all transactions, the most essential thing is the value. What is the value of the business? How to exchange, how to do it. I welcome Manoj. Then we have Sanchit Vijay. He's a registered valuer and CPA from Adre, Chartered Accountant, Partner and Head, Deals and Valuation of Corporate Professional. I welcome him. Now, friends, as you are aware, and I have told in the beginning, these speakers will discuss, and the structure will be like this. First, Sanchit Vijay will speak, then Manoj will speak, and then Anil Kumar Sharma will speak about, because he is expert in plant and machinery valuation. He is registered valuer in this area. So today, all these people, those who are interacting and dealing day and night for these types of valuation client, we will discuss today. Friends, the important thing is when we are finalizing this program, we have identified that the valuation. Everybody know the valuation, but the question is that why you need your valuation. That is one part. But the important thing is that whether you require some incidents when you require valuation, some transaction is going on, then you require valuation, some legal requirement is there, then you require valuation, or you can do your own valuation. So the point is that today, when you have an asset, which is dormant asset, you can value. You can value a building by identifying the market rate and the nearby rate and the nearby transaction, and you can come to the conclusion. But Business valuation is not like this. You can go for valuation for gold, go to the jeweler and he can assess the jewelry value. Go to the property expert, he can value your property. You want to go for machinery and plant, it is a complicated, but there is a fundamental rule on which you can give what is the replacement value, what is the present value, how much depreciation has taken place. But when you do the entire valuation, where including the asset, plant and machinery, business, then you require it consolidated things. And the business valuation is not easy. Business valuation is taking place on the basis of various factors. It can be on the basis of your net asset value. It can be on the basis of a discounted cash flow. It can be on the basis of your business valuation. So when we talk about all these things, it require multiple combination, and this combination is not, sometimes it's questioned that valuation is an art or science. So it is not art, it is not science, it has a science, but it has a input of art also. Okay, but if you can ask somebody that this is the business valuation X person has given, then Y person will give the same valuation. It is not, because it's a perception also. So friends, the business valuation voluntary basis, why you require, because you can understand what are the gaps in your business, because you identified your value through the financial number, then the value which you think of your business you can identify, then you can see what are the valuation of the same business of same peer is getting. Now all these things will not be same, it will be different. So you can compare the gap, that why your valuation which is coming through the league, through the formula, is less as compared to the peers. And then you can compare your gaps analysis, what is the reason and how to fulfill. So sometimes you think that whenever you require some transaction, then I will do valuation. It's a mistake. You do valuation in advance, remove your defects, and then whenever the opportunity is coming, you can do. Because when the transaction is taking place, that time you cannot correct everything. And that time you will feel that because of this reason, I'm losing, I'm getting a less value. So the expert can tell you what is the correct value. So today we will discuss all facets of this particular aspect, and we have a learned people here. And after the program, after the presentation of all, you can raise your question and we'll discuss each and everything. So it's time to Sanchit to give your presentation on business valuation.
Hello, everybody. So we would be capturing all the facets of business valuation, the purpose, what it is, how do we do it, what are the approaches, methodologies, types of assets that we value, all of these assets. Let's start with first introduction. So business valuation refers to the process of determining the economic value of a business or company. It involves assessing the financial and the non-financial factors that contribute to the overall worth of the business. The objective here is that we estimate the fair market value of the business, which represents the price at which the business would change hands between a willing buyer and a willing seller in an open and unrestricted market. Now, coming on to the aspect of the purpose. Why do we need to do valuations? So the purpose of the valuation is to estimate the fair market value of an asset or an entity based on various factors and methodologies. I've listed out a few of the purposes that we do. Let's have a look at them one by one. First is the investment decision. Valuation helps investors, whether they're individual, venture capitalist, or private equity firms, to assess the attractiveness of a business as an investment opportunity. By determining the value of the business, investors can evaluate the potential returns and the risk associated with the investing their capital. Second is M&A. It's very crucial in M&A and transaction. It helps in analyzing and allowing the buyer and the seller to determine a fair price for the business that is being bought or that is being sold. It also helps in facilitating negotiations and deal structuring. Valuations in M&A helps in also assessing synergies and determining the exchange ratio for the shares of an asset. The third and the most important here is the financial reporting and compliance, where the valuation is required. It is very necessary, as accurate valuation of assets and liabilities is important for preparing financial statements, including the balance sheet, income statement, and the cash flow statements. It helps the businesses comply with accounting standards and regulations such as the IFRS, Ind AS, or the generally accepted accounting principles. Fourth, which is the fundraising and financing. As we all know, there's a boom in the startup industry and everybody is raising funds here and there. Valuation plays a vital role when a business seeks funding or financing. Investors, lenders, and financial institutions evaluate the value of a business to determine its credit worthiness, risk level, and potential for future cash flows. Valuation thus helps in raising capital through equity or debt offerings, securing loans, or even attracting investments from external sources. The fifth purpose is strategic planning and decision making. Valuation provides valuable insights for strategic planning within a business. By understanding the value of the assets and the businesses and the management can take very much more informed decision regarding expansion, diversification, capital allocation, or even resource optimization. The sixth is the dispute resolution and the legal matters as a purpose. Valuation is often needed in legal and dispute resolution scenarios where shareholder disputes or business valuation for tax purposes or even independent valuation in family settlement is crucial to determine a fair value to resolve conflicts or even claims. So this was the purpose of the valuation. Now let's look at how do we actually do the valuation. It's a very complex process to do a valuation that requires a systematic approach and a careful analysis. I've listed out 9 points on the process of doing valuation. Let's look at them one by one. The first is identifying the purpose of the valuation. Clearly, we have to always define the purpose of the valuation. Are we valuing the business for sale, or is it for investment purpose or for financial reporting? This understanding of the purpose will help guide our valuation methodology and the level of detail that is required. Second, that is gather relevant information. We have to collect all the necessary information about the asset, the business, or the investment that we are valuing. These includes all the financial statement, historical performances, industry trends, marketing conditions, and any other relevant factor that we may think that would impact the value. Third is the selection of the appropriate valuation methodology. In the second half of the presentation, we would cover what are the approaches and the valuation methodology while valuing. But while doing valuation, it is very important to choose a suitable valuation approach or a combination of them to understand what the fair value would be. We have to factor in the nature of the asset, the industry dynamics, the available data, and even the level of precision that is required. The fourth is conducting comparative analysis, if applicable, obviously, where we perform a comparative analysis using either the company comparable analysis or even company transaction analysis. We identify similar companies or transaction and compare key financial metrics while valuing an entity. Fifth is performing a DCF analysis on the basis of the projections that we have, that is cash flow driven valuation, and applying an appropriate discounting cash flow that is there. Sixth is considering an asset-based valuation. If the asset that is being valued is primarily composed of tangible assets, such as real estate or machinery, we may need to consider an asset-based valuation. We have to determine the net book value of the asset and adjust their values to the fair market value. The seventh factor is evaluating qualitative factors. In addition to financial analysis, we have to consider qualitative factors that may impact the valuation. These can include the company's management team, the competitive advantage, the market position, the intellectual property right or brand value, or the overall industry outlook. The eighth step is calculating the final value. Once we have completed all the analysis using the selected valuation methodology and integrated the findings, and I have arrived at a fair value estimate, we need to calculate the final value in relevance to our specific evaluation context and the purpose. Ninth, which is the documentation, that is assigned valuation report, and the communication of the value, that is by preparing a comprehensive report document of the assumptions, the findings, and the process, clearly communicating the value and the results and underlying analysis and any limitations or uncertainties associated with that. It is very important to know that valuation is not an exact science and it involves a lot of subjective judgments and assumptions. Different evaluation approaches can yield different results, and professional judgment is very crucial in interpreting the data and selection of appropriate methodologies. Let's have a look at the concept of fair valuation. So fair value in valuation refers to the estimated or intrinsic value of an asset or entity based on its current market conditions and relevant factors. It represents the price at which an asset would be exchanged between knowledgeable, willing parties in an open, competitive market. The objective is to reflect the economic worth of an asset or an entity, regardless of any specific individual preferences or circumstances. The determination of fair value involves a thorough analysis of both quantitative and qualitative factors. Also, I would say that fair value is very different from historical cost, which represents the original cost of acquiring an asset or entity. While historical cost definitely provides a reliable and objective measure for certain purposes, fair value aims to capture the current value of an asset or an entity. I would now look into when do we need valuation. So valuations is required at various steps. Whenever we are doing mergers and acquisitions, whenever we're doing any business sale and purchases, that is when buying or selling a business, it is necessary to determine the fair market value of the business. IPOs, when a company plans to go public by offering its share to the public, valuation is required to determine the issue price of the shares. Private equity and venture capital investments. So valuation plays a crucial role in private equity and venture capital to evaluate the value of the target company to determine the amount of equity that needs to be acquired. So financial reporting is there for compliance purpose. Bankruptcy and restructuring it. So in situations involving bankruptcy or financial distress, valuation is needed to assess the value of the assets, liabilities, and the overall enterprise. It helps to determine the recovery value for creditors and evaluate potential restructuring options, and also support negotiation between the stakeholders. Share buyback. Valuation is essential when a company repurchases its own shares from shareholders. It helps determine the buyback price and also ensure the fairness to the shareholders. Litigations and disputes, as I conveyed earlier also, in terms of the resolving of the claims and conflicts, we need valuation. So these are few examples of transaction and situation that commonly require valuation. The need for the valuation arises whenever there is a need to determine the fair value or market value of an asset, business, or financial instrument for various purposes, including investments, reporting, decision-making, or even legal requirement. There are lots of other domains also where valuation plays a crucial role, and we need to cover financing and investments, real estate, M&A, corporate finance, financial reporting, all of these. Now, let's have a look at certain factors that affect the valuation. Valuation is dependent and can be impacted by all these factors that I've listed out here. These factors vary depending upon the industry, the company size, the growth prospects, the marketing conditions, and specific circumstances. The first factor that I would cater to is the financial performance. The financial performance directly impacts the valuation of a business, and factors such as revenue growth, profitability, cash flow generation, financial stability impacts the perceived value of the business. The second is the growth potential. The growth prospects of a business strongly influence its valuation. Expansion opportunities, innovation, product differentiation, and competitive advantages are considered very imperative in valuing a business. The third is the industry and market conditions. The industry which a business operates and the overall market conditions play a very significant role in valuation. Favorable market dynamics such as high demand, limited competition, and growth opportunities can positively impact the valuation. Conversely, industries facing challenges, competitive pressures, or market disruptions may have a lower valuation. Fourth is the risk and the uncertainty. The level of risk associated with a business affects its valuation. Factors such as industry volatility, competition, regulatory environment, technological disruption, customers concentration, and financial leverage impact the perceived risk and subsequently the valuation. The fifth is the customer base and relationship. The size, diversity, and quality of a business customer base are important factors in valuation. Long-term customer relationship, recurring revenue streams, and a solid customer retention rate contribute to a higher valuation. The next point is the intellectual property and assets. So IP, such as patents, trademarks, copyrights, and proprietary technology, as we see in the new age technology company, can significantly impact the valuation of a business. Valuable and protected IP assets contribute to a competitive advantage and potential revenue stream, positively affecting the valuation of any entity. The next is the management team and the human capital. The quality and the capability of the management team have a significant impact on the valuation of a business. A competent and experienced management team with a successful track record may enhance the perceived value of the business. Additionally, the skills, expertise, and retention of key employees and the overall human capital of the organization can also influence the valuation. So the valuation, whenever we do, we follow the international valuation standards, and the objective of the international valuation standards are listed as under. So reliability is one of them. It helps increase the confidence and trust of the user of the valuation service. Global recognition, promulgate considerations, and coherence. So all of these factors are the objective behind doing any valuation. And whenever we follow any approach or valuation methodology, the backbone is following these valuation standards by AIVSC. There are certain provisions under Act which require valuations. We have listed out a few of them here. Companies Act, Insolvency and Bankruptcy Code, Income Tax Law, FEMA, SEBI Law, SARFAESI Act, Indian Accounting Standards. This is not an exhaustive list, but these are certain acts under which we have to do valuations with different approaches, different methodology, and formulas. If I capture a few of them, provisions under the Income Tax Act, under the Companies Act, where we require valuation, are listed out here. We require valuation whenever we are doing a further issue of share under schemes of compromise or arrangement, to value equity shares held by the minority shareholders. Regarding valuation, for circulation of meeting of creditors. So the different sections require valuations at different stages, and accordingly have different approaches too. Under Income Tax Act, we require valuations for unquoted equity share, unquoted shares, transfer of shares, for valuation for capital gain, transfer pricing, indirect transfer pricing, or even equity shares held by the minority shareholders. Provisions under Ind AS which require valuations have been listed out, where we capture Ind AS 2, Ind AS 16, property, plants and equipment, Ind AS 40 whenever we're doing an valuation for investment property, Ind AS 106. There are other fair value measurements, financial instruments, business combination, and employee benefits, Ind AS 19, where valuation is required at different stages. I would like to take a moment here and capture on the aspect of voluntary valuation. So, a voluntary valuation by a business refers to the proactive decision of a company to conduct a valuation of its asset, business, or financial instrument. It is initiated by the company itself rather than being driven by external requirements or any law. There are certain reasons why every entity or every company should look at voluntary valuation. I've listed out a few of them. The first is the strategic decision making. A voluntary valuation can provide valuable insight to support strategic decision making within the company. By understanding the current value of the business, the company can make informed decision about the resource allocation, capital investments, and expansion plan. The second is the internal performance assessment. Companies may opt for voluntary valuations to assess their internal performances and financial health. It can help identify the strength, weakness, and areas for improvements within the company. The third is the investor relations and reporting. Companies often conduct voluntary valuations to communicate their value propositions to the investors and stakeholders. By obtaining a professional valuation, companies can provide transparency and credibility regarding the worth of their assets or business segments. Fourth is compliance and governance. Even in the absence of specific regulatory requirements, companies may and should opt for voluntary valuation to demonstrate compliance and good governance practice. By conducting periodic valuation, companies can ensure that their assets are fairly valued and aligned with the best practices, enhancing their credibility and transparency. Fifth point is the shareholders' wealth management. In cases where a company has multiple shareholders or shareholders with different interests, a voluntary valuation can help manage their shareholders' wealth. The last is the succession planning and business continuity. Business may choose to conduct voluntary valuation as part of the succession planning and business continuity efforts in order to understand the value of the company's assets and business operation, which can aid in smooth transition of ownership or leadership within the organization. It is very important to note that voluntary valuation should be conducted by appropriate valuation methodologies, and should be kept in mind why we are doing the valuation. Thank you, everyone. The next part of the valuation approaches and methodologies would be led by Mr. Manoj Kumar.
So thank you, Sanchit. Thank you for giving the deep depth analysis of this valuation concept, and interestingly, the concept of voluntary valuation. Friends, the last point Sanchit has mentioned, succession planning. I'm just giving you, I'll give you example continuously after the speaker, but one example I'm giving on the succession planning, the why this valuation is required when, even if you are not required to take the law.
Oh, sorry.
So the first point is that we are giving one example. One client came to us and they were having a family dispute, and they told that do the valuation. we did the valuation. So the valuation was on the basis of business that was in crores of rupees, in three figures, more than more than 700 or 600 crore. Now, according to the discussion, if the person who is going out, they were thinking that he can go out and they will pay some amount. But when the valuation took place, the huge number was huge. And they have decided, okay, you can go. But the financial figures, because you have one is the valuation, one is the liquidity. You can have a high valuation, but you can't have a liquidity of the same amount. How to pay that amount to that person? So these types of problems can come, and these types of issue can come when you are doing succession planning. So it is better that if we can get our value in advance and accordingly make the plan. So I'll discuss with you other points also. So now Manoj, your turn. Over to you, Manoj, and tell us the insight of the valuation.
Thank you, sir. Good evening, everyone, for joining in such a huge number. Valuation is always a very technical subject, and generally it is not of the interest of everyone. But yes, as sir was telling, voluntarily doing valuation for various purposes is obviously legal requirement, and companies carry these valuation as per the need, as per the requirement of the statute. But there are situations when business or persons should get their valuation done voluntarily, because valuation, and if we are talking about the valuation is always a very subjective thing, and it has, though it has codified or well settled position that there are certain approaches through which valuation is done, but still there are a lot of personal bias, personal opinion of the valuer gets involved in the valuation process. So which depends upon perceptions about the business, perception about the management, industry, etc., economic factors, external, internal, all. So it is very important to understand the nuances of the valuation. If you are going for valuation, what are the major approaches of valuation and methods of valuation through which businesses are generally valued, and at what stage which approach should be applied, comes as per the experience of the person. So now I would discuss here what are the basic approaches to the valuation and methods of the valuation which are applied. So let me share my presentation. So if we talk about the approaches to valuation, there are only three major approaches. One is the asset-based approach, second one is the market-based approach, and third one is income approach. So these are the three basic approaches under which all kind of business valuations are done. However, there can be, the valuer may apply a combination of these approaches, or select any one of them or two of them to determine the fair valuation of any business. If we talk about first approach, which is asset-based approach, which is always considered to be the bare minimum or minimum proxy value for any business. So it comes with can be done through three methods. It generally determines the value of assets and liabilities, and net of the assets and liabilities, or difference of assets and liabilities, considered to be the book value of the business, or fair value of the business on net asset based. So the book value, or the business asset-based approach, can be based on the book value, which is the historical value of the assets or liabilities in the books of the company, or it may be based on the realizable value. So here we will go for the fair value of the immovable properties, investments, etc., which can have a different value than the amount outstanding in the books of the company. So that is called the realizable value. If we go to sell those assets in the market, what value these assets can fetch, or what can be the settlement amount for any liability. So that will be the realizable value of assets and liability, and the net of them is considered to be the fair value. The third is the replacement cost, where if there is a factory or business which can be replaced by replacing all the assets or liability, what amount of investment is required, that is considered to be the net asset value under the replacement cost method. As we understand that these are basically the asset and liability based approach or balance sheet based approach. It does not take into account the earning capacity, earning potential of the business, or what comparables or peers are getting value and for the similar line of business, similar size of business. What can be the external factors, internal factors, subjective factors? Those are ignored in this, and hence it is considered to be the minimum proxy value of a business. And generally, these methods are generally taken only for certification purposes, where price to be determined as per the law. So let's say we are talking about transfer of shares, then income tax prescribes the valuation based on this method. And then that is applied to determine the minimum price at which share can be transferred, an unlisted share can be transferred from one person to another. But if we are talking about the fair business valuation, it is not the fair business valuation, it is the pricing of the company. The second approach is the income-based approach, or the most popular income-based approach is the discounted cash flow or discounted free cash flow of the company. So here it is assumed, it basically factors the cash flow which can be generated from the business. So and that those future cash flows are discounted to brought them to the present value, and then based on that the valuation is carried. So these are very common methods of determining the value of any business. It is most commonly used methods for determining fair valuation of any business or any going concern. So here what we do generally determine the time horizon for which cash flow projections are made, which then forecasted cash flow is made for those periods. Then a fair discount rate is determined considering various factors. And then the present value of the cash flow of each of the years is determined by discounting those cash flows as per the discount rate determined by the valuer. And then that there may be certain terminal value for the business, because let's say we are doing projections for 5 years. Even after 5 years, there will be certain value left in the company, or it may be consistently growing after that period. So those value is determined as a terminal value, and the sum total of the present value of the cash flow plus terminal value of present value of the terminal value is considered to be the enterprise value of the business. From the enterprise value, there are certain adjustments like cash and cash equivalent standing on the date of valuation is added back. If there is some surplus assets which can be sold in the market, those assets are added back, debts are reduced, and hence in this way the equity value of the company comes. Then if we talk about the third method, which is very common and which is generally used as a thumb rule in day-to-day affairs, which is the market approach. Here, what is done? We determine the industry or the segment in which the company is acting, is manufacturing or providing services, and those comparable companies or comparable transactions are valued at a certain rate by the market. So those listed peers, let's say we talk about some industry, let's say steel industry. So there are 100 companies acting in this industry, and there out of that 60 is listed entities. So listed entities are getting traded at a certain multiples. So those multiples are applied with certain adjustment to this unlisted entity, and based on that the value is determined. So that is called the comparable company multiple or comparable transaction multiple. And this method is very popularly used for various kind of valuation practices. Here what we do generally identify the comparable companies, gather their financial data, calculate the average multiple. So average may be mean or median of those companies, and that multiple is applied to the company's financials. Consider there can be certain adjustments based on the high or low performance of the company under consideration, and based on that the discount factor or premium can be given over and above the comparable company multiple of that industry, and based on that the valuation of the company is determined. Then we under this industry approach, we may also apply comparable transaction multiple. So comparable transaction multiple is almost similar to the comparable company multiple, where listed peers are taken. Here we are talking about all transactions of the similar industry happened during certain period in past. So that is considered as a method to determine the value of the company. So very common methods of valuation are, let's say we are talking about the valuation of a company. So EB by EBITDA is very common method to determine the comparable company multiple or comparable transaction multiple. So we determine the enterprise value of various entities and the EBITDA multiple being available to those entities, and based on that the valuation is determined. So these are the three major approaches under which valuation is carried. As and when we try to apply any method of valuation or approach of valuation, we should consider what are the factors which need to be considered. So most important factor is the peer entity or peer transactions, what we are determining for the purpose for taking the valuation. So let's say we are talking about a steel company, and a steel company can be carrying a business of 100 crore or maybe 1,000 crore, maybe 20,000 crore. So comparing a company with 100 crore turnover with a 20,000 crore turnover would not be a right comparison, and hence we should take with the a comparable entity which are in the range of the company and for which we are doing the valuation. So that is the choice of peer is very important. The other things there may be certain cross holdings, cross investments. So those factors need to be taken care of. Then there can be certain assets which are not in operation. So those would not get captured in the value of the comparable entity or comparable company multiple valuation. So excess cash, excess non-operating assets or non-core assets of the business should be reduced or removed, or their value should be added back to determine the fair value of the business. Then there may be different accounting practices, different tax jurisdictions applicable to the company under consideration and the peers for which we are taking the multiples. So those adjustment is also very important. Then based on all the subjective factors, we may apply certain discounts or premium. Like very common discount is in case unlisted companies is getting valued based on the multiples of listed peers, then lack of marketability discount is always given. So which is very common, that is called DLOM discount, which is very commonly given. There can be other factors also. So there can be certain companies for who will get premium also. Like if their ROE or ROC is much higher than other companies, then they should be given certain premium. So those adjustments are done based on the experience of the valuer or factors which are got determined during the due diligence process of the valuation. Then there can be various class of valuation assets for which valuation is required. So there may be for certain business purposes or certain transaction purposes, we need to determine the valuation of land, building, inventory, plant and machinery, goodwill, patents, or other intangible assets. So for that, there are different approaches or different methods which are applicable. I think tangible valuation, asset valuation would be discussed by Mr. Anil Sharma ji. So I'm not touching that up here. So we will discuss, there are certain special situations for which special methods are generally applied. So first, let me discuss about startup or early stage company. So we have seen that in case of startups or early stage companies, there may be a situation where cash flows are there, but profitabilities are not there, or the company is growing so fast that projecting cash flow realistically for next 3, 4 year, 5 year is not reasonable. There can be disruption. There can be the growth may be much higher than what can be projected by the management at present with certainty, or their projection may not be achievable at all. So considering those factors, there are special methods are applied. So there are 3 major approaches to determine the value of startups. One is first Chicago method. Another one is venture capital method, and third one is the scorecard. Scorecard is basically complementary to the first 2 methods. So we will discuss these 2-3 methods. If we are talking about the first Chicago, it is also generally this valuation is generally done based on the discounted free cash flow only. But we for determining the discount rate, there are 3 scenarios are taken, or the cash flow is projected under 3 different scenarios. One is the base scenario, which the management feels that they can achieve easily. So that is considered to be the base projection. Then there will be an projection with upside case. So here the management is allowed to provide their best case scenario, whatever they feel they can achieve over a period of 5 years, they can project. And the third one is the most conservative and considering the downside. If the business is not growing, if the competition goes, or there are other factors which does not allow the company to grow as they have projected, then what will be the downside? So these scenarios are determined, and all these three under all these three methods or scenarios, discounted cash flow valuation is done, and then a certain weight is given to all the three, and based on that, the fair valuation of the startup is determined. If we talk about the venture capital method, it is a variation of the earlier method, which is the first scenario. But here the approach is the investor always want exit from a company because they are financial investors. They don't want to continue with the company. So what should be their fair expectation at the time of exit? That is considered as the fair valuation of the company, and that valuation is taken back to the present value by discounting at various rates to determine the fair value. So let's say we consider that let's say a venture capitalist is putting 100 crore in a startup today, and they expect that after 3 years there will be an IPO where they will exit. So for 3 years, what IRR, internal rate of return, they are expecting? If they are expecting, let's say 14% or 15% or 20% return over a period of these 3 years, and there are risks involved. So considering those risks, what should be the right value of the company after 3 years? That is determined, and their present value is considered to be the fair value as on date. The third one is basically a scorecard. A scorecard is the supplementary to the first and second method, which I have discussed just now. And here we put additional factors to various kind of things like stage of the startup development, market potential, quality of the team, intellectual property, competition already there or not, growth prospects, which is already determined or which can be perceived by the valuer. These factors are given certain weights. So let's say equal weights may be given to all these 6-7 factors, or maybe different weights can be given to various different factors, and that determining factor is applied to the fair valuation determined under, let's say, first Chicago method, and that will be considered by the investor to put the money. So this can be these are more subjective kind of valuation, but that is very well prevalent in the industry of startup industry basically. If we talk about the another situation where the company is a loss-making company, so it may be a startup, it may not be a startup, but here in case of loss-making company, it is very difficult to determine that apply the traditional methods of valuations because the positive cash flow is not coming. So there can be different methods to determine the valuation of those companies. It may be one of the simplest method is to determine the net asset value. As I discussed earlier, in case of net asset value, we may apply realizable value of those assets, or maybe we may consider a replacement cost of those assets. So replacement cost also can be applied considering the factors like certain industry can be established within a certain very small period of time period, but there are certain industries which takes longer gestation period, like if we are talking about the power plant. So thermal power plants may take 4 or 5 years to establish. So that the replacement cost would also take into factor the time lag. So let's say we start process today, we will be able to start generating the cash or generating the power over a period of 5 years. So 5 years is the time lag also, which is very important factor here. Then as the cash flow profitabilities are not there, there can be another method, price to book value. So the shares value can be determined as a certain multiples to the asset value. Total assets, let's say total asset value is 100, and we apply 2 times of the assets. So there 2x of the book value of the company can be the fair value of the business, which may be considered. Then there may be, in certain circumstances, top line is very important, or sales is very important. It may not be generating the profit, but the top line is growing. So in future, it can start generating profitability. In such cases, certain multiple to the sales can also be given. So wherever there are brand associated business, where a brand is getting established over a period of time, in the initial period there can be negative cash flows or negative profit, no profit. In such circumstances, sales multiple is given, so that as the sales are growing continuously over a period of time, the company would start generating profit also, it is assumed. Then if company or management can give projections of the cash flow, positive cash flow after 1 or 2 years or 3 years, that can also be, then DCF method can also be applied to determine the fair valuation. Another situation can be a liquidation situation, or when the company is getting closed down. So here it can be under insolvency situation, or otherwise voluntarily liquidation or voluntary close down of the business, maybe the situation. In such situations, obviously there is no purpose of determining the free cash flow of the business. There is no business, there is no going concern status. In such case, obviously the net asset value is the best method to determine the value. There can be, if the situation is forced situation or stressed situation, then there will be high discount which will be applied to the fair value, even fair valuation of the assets. But otherwise it can be replacement cash flow can also be a fair valuation of the liquidation disputes. If there are a situation where assets cannot be easily realized or liquidated, then we need to apply these methods. Otherwise we have to go for fair valuation based on the net asset or replacement value method. Then there can be situations like ESOPs or any other options which are being given to someone. So if I am a holder of an option and I want to determine the value, what should be the value for me? So for that, there are different methods like Black-Scholes method, which determine the present value of the options. So options may or may not get converted, or there can be situations which gives right to the option holder to get it converted after a certain period of time. So considering these factors, Black-Scholes or binomial models can be applied to determine the fair valuation. If we talk about the Black-Scholes method, basically it is a mathematical formula for valuing European style options. So European style options is basically the options where the mid of the period is considered to be the fair right to get the options. So here different factors like underlying assets price, strike price at which it can be converted, time expiration, so when the right is arising, then risk-free rate of interest going on in the market, and the volatility of the underlying assets. Let's say if it is getting converted into equity, what is the volatility of the price of that asset or that equity can be the determining factor based on the formula is applied, and then fair value of the determined. If we talk about the binomial method, again they use mathematical to estimate the value of options by breaking down the time expirations of each series of the after discrete intervals. So it is a more detailed and complex method of determining the value of stocks or options given under the ESOP or other or options and futures of any listed company. Then if you talk about the intangible value, so valuation of intangible assets, it is also very critical to sometimes to determine the fair value of intangible assets. So intangibles may be goodwill, sometimes it may be some patents. So considering the type of intangibles, different approaches are applied. Like in case of goodwill, we can consider the super profit of the business being earned due to the goodwill that can be capitalized to determine the value of the goodwill. But in case of patents, what patents generally gives exclusive right for certain period to the business owner. So that during this exclusivity period, there will be high earning to the business. So those extra high earnings can be capitalized to determine the value of the patent. So there are considering the type of intangible assets, different methods can be determined, applied, and based on that, intangible properties can be valued. Intangible property may be required to be valued for mergers, acquisition purposes, sale of business, purchase of sometimes only intangible assets are acquired by some company, like some FMCG brand is being acquired. So they have to determine what is the market share, what territory they are getting, those FMCG products are getting sold, and what are the competitive scenario of that industry. Considering all these factors, the value of those intangibles are determined. So whenever valuation is being done, there is a need to, there are various challenges, as the valuer need to apply various kind of subjectivity factors or its own opinion. So the law says that whenever we are doing valuation for any particular law, we need to understand that there are certain challenges for the valuer, certain obligations, regulatory obligations, which are very, very important. Like if we are talking about the registered valuer, they are governed by the Companies Act and the rules, regulations made there under, and they have to consider there are multidisciplinary approaches. There can be various regulators who are looking into the methods being applied, the approaches you are carrying, the intent of the extent of diligence you are carrying. So those things can be questioned by the regulators, by court of law, and sometimes in case of dispute. So we have to be very, very careful while applying all or any of the method, and we must justify with the logic and which methods we should apply for, which we have applied, or which kind of discount of premium we have given, what is the logic behind that. All those things are of valuation. And I think for tangible assets and Anil sir would go deep into it and discuss various aspects of the same. Thank you very much, sir.
Thank you, Manoj. Thank you very much for giving depth analysis of type of valuation. No doubt, when I gave my initial remark, this is not, it's not a science, it's not a art, it's a combination of everything.
Right.
Now the regulator is also watching, so you have to be very careful. We will talk to you and ask you so many questions during the question hour.
Sure, sir.
Over to you, sir. Now the point is, you have seen, you are doing day and night the plant and machinery valuation. Now today we want to understand what are the difference on the plant and machinery. It is just say asset valuation, or something more, or something different, and what methodology you follow. Please, over to you, sir.
Thank you, sir. I think both Manoj and Sanchit have set a very high standard for me, so I'm going to try and meet the standard. I mean, there has been some, I think, slight miscommunication about. I'm not strictly covering tangible assets. I'm actually covering more to do with standards, I think, at the moment for this particular seminar. And I at some time in a future seminar, I can go more deep into tangible assets valuation, which is plant and machinery valuation, my sort of forte, right? And in this particular session, I'm going to cover how the standards look at the scope of work in a valuation, how it looks at investigations, what it expects the valuers to do, and also in terms of the reporting in the final report by the valuer, what is expected from the valuer in terms of the report, right? So these are the three aspects, but I will try and bring in some flavor of tangible assets valuation while I'm talking about these aspects. So just to introduce myself, I am a plant and machinery valuer registered with IBBI. I'm also a wealth tax valuer. I'm now a director in corporate valuation services, corporate professional valuation services, RVE, which is hosting the seminar. And in fact, the group is hosting the seminar, and both Sanchit and me are part of the same RVE. Then I'm also insolvency professional, so I have some deep deeper sense of what the insolvency laws say about valuation. As you know, that valuers today are being governed under two different regimes. One is under the company law, and the other is under, of course, there are SEBI registered valuers, but essentially there are company law registered valuers, or there are valuers who are governed by the Wealth Tax Acts, right? So there are two different regime of valuers, and both cover, wealth tax valuers generally cover the income tax valuations and valuations under Wealth Tax Act, or SAFESI auctions and stuff like that. Whereas IBBI valuers are doing all the remaining, most of the other valuations. So essentially, it's important to understand what we need to put in the scope of work, when we start doing valuation. So it's important for the valuer to crystallize the scope of work, and for the client to jointly understand to agree on the scope of work, which is understood by the valuer, and one of them or both of them work together to create a acceptable scope of work. So what is the standard? The IVS lays down certain basic, expectations out of the scope of work which is, being created, right? And it falls under the standard known as IVS 101, right? So all valuers have to adopt a valuation standard, and generally in India we are adopting IVS, right? Of course, there can be deviations from the standard based on the local laws. So if there is a, there is a disagreement or deviation in terms of a base of value, in terms of any other aspect of the valuation because of the local laws here, then IVS permits you to deviate from the IVS standard, and expects the valuer to sort of adopt the local law, and in which case there's no full compliance with the IVS, but then it's permitted by the IVS, right? By the way, there is a strict regulatory regime for the valuers to sort of regulatory norms that valuers have to meet. There are standards, there are ethical standards, there are professional standards that we have to meet, and one of them is that we need to adopt a strict a professional valuation, international acceptable valuation standard, or an Indian valuation standard, which which you need to declare in the report that you are writing for the in terms of the valuation, right? So it's mandatory. So what does the scope of work comprise of? Okay, so you need to identify the assets that are being valued, right? The purpose of the valuation, right? The most important thing is you start with the the client, who the client is, who the what the expectation of the client is in terms of the purpose of the valuation, and who are the users of the reports going to be, the identity and the license of the valuer. So very often a client approaches a valuer and doesn't sort of doesn't outrightly, or doesn't sort of clearly indicate the purpose of valuation, and that is not acceptable in IVS. I mean, you ought to have, the purpose of the valuation which is put down in the report is what needs to be understood clearly agreed between the valuer and the client, right? The other expectation is when you're agreeing on a scope of work, or when you're accepting any assignment or engagement, then you are sort of declaring that you're unbiased and objective valuer, right? So the valuer has to, mandatorily declare that there's no prior association which can interfere with his independence or interfere with his, biases. So you cannot be a, an auditor and a valuer, right, of a company, right? So you cannot do that. That is not permitted. Or you cannot be a professional who's attached to the company or to the business that is being valued, or a creditor or this thing, and at the same time try and value the assignment, right? That is not possible, permissible. The other, the next thing that you ought to worry about is, what the valuer needs to worry about is whether there are going to be any limitations to the use. So if there is let's say there is a insolvency valuation, let's say there is a lending, lending institution is getting something valued because they need to know the underlying security, which is this thing. So that there is a limitation to its use. It cannot be used for any other purpose, right? It cannot be used for some other third purpose, which has not been clearly understood between the valuer, and therefore the valuer would normally restrict the use of the of the values which are being computed in this report to the purpose of the valuation that was declared between them, right? Clearly, of course, identify the assets which are being valued. So suppose I'm a category plant and machinery valuer. So when I write my report, I need to clearly identify those assets. I cannot barge in or cannot intrude into other asset categories. For instance, I cannot, usually I would not do inventories, or I would not do current assets, or I would not do land and building, because I'm a plant and machinery category asset valuer. So, you need to identify those assets, and you cannot impinge into other asset categories. So that is another, restriction in the scope of work that you need to identify. But of course, there can be an RVE, a registered valuer entity, doing all the three asset categories, and therefore, you identify the assets cumulatively, right? If there are going to be any limitations to the investigations that the valuer is undertaking, then that needs to be identified, and whether it's going to, whether that is going to take away a lot from the outcome of the valuation, or the opinion cannot be then held with certainty, then I think there is a problem about taking that assignment, right? So if there is a huge lot of information that is not forthcoming from the client, and which restricts the investigation, and I'm going to come to the chapter of, to the part of investigations, then that ought to be, you need to clarify that, what are the mutual responsibilities. So there is a responsibility that rests on the client to share, let's say, the past production performance for the last 5 years, or let's say, the wastages, or let's say the energy consumption, or let's say, that I may in particular need, which is of significant value as a valuer to me, right, in terms of computing the value, right? Or let's say, the critical raw material contracts in place, or let's say the historical costs, which are, I need the FAR, for instance, the fixed asset register, which gives me the historical cost. So I may consider all of these as important elements of the information that the client ought to provide to be able to do a good investigation into the valuation assignment, right? So all this needs to be. The next important thing is assumptions and special assumptions. If there is going to be any, there are going to be definitely certain assumptions, so that need to be clearly understood between the client and. So if a company is being valued, right, and let's say they're hiring 3 different valuers, and let's say one valuer is assuming that the company is closed and shut down and needs to be restarted, his assumption of doing the valuation is that, right? The other one takes another valuation that he does another that the company is operating, for instance, right? He assumes the company is operating. The third one assumes that the company is the assets are being built. So I'm saying, the point I'm making here is the assumptions need to be aligned with the client. I mean, they need to be parallel. Assumptions need to be in parity between the valuers doing valuation, because quite often you have more than one valuer valuing assets or businesses, and in particular when there is a law in place under which it's being valued, right? So assumptions which are significant in nature, they ought to be clearly clearly put down in the scope of work, and that is the important assumption that is going to be assumed by the valuer when he carries out the valuation, right? The IVS permits this change of scope of work as facts emerge during the course of the assignment, and it needs to be recorded. Of course, it's it's better that the valuer records in the scope of work, right? So you may be a little confused about what are assumptions and what are special assumptions, right? This is slightly technical, but then it's important for us to understand. Now, when you're actually asked to do valuation, you're basically asked to do valuation on a particular date, right? I mean, that's the date of the valuation. That is clearly recorded in the scope of work also. And then it follows in the valuation report also. If the assumption, right, if the assumptions that are being, assumptions are those, basically those things those situations which are captured, which are borne by facts on the ground, right? So if there is a closed plant, and my assumption in doing the valuation is the plant is lying closed, right? And I still need to calculate the fair market value of that, right? But my assumption is that, right? So actually it's borne by facts on the ground, right? That is a assumption. A special assumption is that which is not borne by the facts on the ground. For instance, that on the date of the valuation, let's say that a part of the business was not ready, right? But on the date, while doing valuation, you assume that the part of the business is now ready, right? That is not borne by the facts on the ground. That is a special assumption. Now you need to record, the valuer needs to record this in the report and in the scope of work, so that any special assumption that is being made is sort of overtly declared in the report, and the user of the report actually bears that in his evaluation of the report, and he understands that this is the underlying special assumption that is being used. And I'll give you a more more real life example. Now this is a real case where I happened to handle. So this is a power plant of approximately, I think, 450 megawatts or 600 megawatts. There are 4 units and 3 units, or 150 megawatts each. And one of them, 2 of the units had achieved commercial operations about 18 months back, but a 3rd unit was not complete to the extent of 50%, right? Now, when I did valuation, I assumed that on the valuation date, that I assume that this is going to be completed and not borne by the facts on the ground, right? So this is a special assumption that I make, because I assume that the company is going to be a going concern. The power plant is going to be a going concern. There are contracts in hand in the other 2 BTG plants which are operational, and there is a likelihood of business taking place in in the 3rd unit as well. So I assume using a special assumption, right? So therefore a transaction is therefore being hypothetically assumed that the plant will be completed, and whatever transaction or fair market transaction that is taking place is actually on the basis that the plant has been completed. So therefore I assume a certain cost to complete, and I assume obviously the income flow coming in only after, let's say, 18 months from the valuation date. But this is a special assumption that I have assumed while, and there can be numerous instances, of this thing, of this sort of an assumption. And IVS permits you to take special assumptions which are agreed between, the client and the valuer. And they also suit the purpose of the valuation, right? They also must suit the purpose of the valuation, and that is very important, right? It cannot be completely in the air, right? I'll touch upon another technical jargon that is used in valuation, which is you often hear, or you will probably see it in the reports as well. The premise of valuation, right? So the premise of valuation is the circumstance under which the hypothetical transaction is taking place, right? So what it means is that if I assume that the company is a going concern, I am basically assuming a circumstance under which the transaction is assumed to take place. That is, the sale is assumed to be taking place, making the existing use of the assets, right? So whatever is the existing use of the assets, that is what is being, that is a premise, right? So my premise is that the existing use is going to be, is going to apply, and I value the assets on the basis of existing use, the assets in place at the same this thing. And obviously there are going to be intangibles in play, and there is going to be, together with the business contracts in hand and all of those things, right? So there's staff and there is manpower, there is there's knowledge there's sort of tacit knowledge in the organization and all of those things, right? Whereas when the premises, let's say if the assets are sold on liquidation on a piecemeal basis, what I'm assuming here is an X32 sale, which is the assets are being removed from there and sold on a piecemeal basis, right? And usually it is sans business and without an intangibles. So the intangibles are being removed, the business is being removed, and that is, that's my premise evaluation, right? So the premise evaluation being assumed, being taken into consideration must be consistent with the intended use, right? So if, for instance, there is a security lending, let's say there is a security lending of the tangible assets only, not the intangibles, right? So assuming that the financial institutions has lent money on the tangible assets, right? Now, if I'm valuing, if the purpose of the valuation is that what is the underlying security, right? I am obviously going to assume, I would be more inclined to assume that the business is not, the plant is not being sold with the business, because usually the underlying security comes into play when the assets are being they're being actually held. They're being, first of all, taken possession of by the financial institution and then auctioned, right? So the premise of the valuation, the logical premise of the valuation there would be that it would be, the asset would be auctioned without the business and without the intangibles, right? Now that basically flows from the purpose of the valuation itself, right? Whereas if I was doing it for, let's say, merger acquisition, or let's say a business being sold, then I would, then the premise of valuation would be a going concern, because the business is actually running at the moment. But then therefore I'm my assumption there, or the premise evaluation, is a going concern, and it's an existing use. The same business is being simply acquired by someone else, and only the owners are changing, and therefore the premise evaluation can be, it will be different. So just to I'll cover investigations. So there is a standard 102 in terms of investigations the valuer is supposed to do, right? That this is intricately linked to the assets being valued and the approach being used, right? So if you're doing a net asset, the asset valuation approach, let's say usually, which is called in other terminology, cost based valuation. So there, the two important pieces of information that are relevant to it: the historical cost and the replacement cost. So my inquiry or my investigations would be spread more around historical costs, and I'll go deep into the FAR. I'll go probably deep into the contracts when the plant was built, or when the assets were before the assets were put into running. I may go into the EPC contracts and all that, and then I will take a deep dive into investigations using using some of those inputs, right? And on the market side, I will inquire about the available machines and the plant and available assets, the replacement cost, right? So I will do I'll basically focus on these two aspects, right? But if I'm using a combination of approaches, let's say I'm also using income approach, then I may go into many other things, right? I may go into the income generating capability of the asset. I may go into the capacity of the plant, the revenue flows, the cost of energy in producing the the high cost raw materials, how they're going to inflate over time, the costs. And so I'll look at two things: the financials, as well as look at the forward-looking factors that will determine the costs in the marketplace, right? if I'm applying the sales comparable transactions approach, then I'll do investigation, deep dive investigation into similar assets being sold, maybe the exact assets being sold. I'll do a comparison between the subject asset and the assets being this thing. And therefore, the investigations are basically linked with the purpose and the assets being valued and the approach being applied, and also the the premise of valuation also, right? So if you're doing a liquidation premise, right, if the premise is basically assets are being sold on a piecemeal basis, you generally rely on cost-based approaches or asset valuation approaches, right? Whereas when you're applying, when your assumption is the business is running and the entire business needs to be valued, the assets are being just part of the whole business, then you are basically looking at a different level of investigation, right? You're looking at more income side. You may still factor in the cost approach, but you would generally go into those investigations, right? The last bit that I want to quickly cover is what needs to be there in the report, right? So it clearly stems from the scope of work itself, but a report must be basically very clear on how the valuer reached his opinion, right? He must provide the important computations and the logic and the reasoning. As they say, it must be a reasoned report as to how he arrived at the value of the asset, right? So he must be able to give you if he's done proper investigations and and all the procedures have been properly applied, then he must come up with a reasoned report for the intended user to be able to understand the asset that has been valued and what are the major factors that have been borne in mind while valuing the assets, right? There should be a clear disclosure of the assumption, the special assumptions, and the purpose of the valuation should be put back there, the basis of value, and clearly the basis of value should be defined there, should be clearly understood by the user. And of course, there is any uncertainty in the value, which is for instance, we were doing a plant which was obviously which was basically alumina refinery, with the whole plant had actually come up, but because of the captive mines being dislocated with the there was no raw material supply coming in from the captive mine because of some government related problem, and there was some sort of just they didn't sort of fulfill the contract with the company, and the major raw material, the bauxite, was not available to the alumina refinery. So the whole alumina refinery was lying there and was basically lying there. And even though the assumption that the special assumption that we made was that it would be running and there would be a discounted cash flow analysis was also done, both cost approach and the discounted cash flow analysis was done. But the underlying uncertainty was very clearly put in the report, and alternate sources of bauxite were considered as to how, because it was close to the port, so we considered alternative import routes for bauxite, and therefore the reliance was instead of being from the captive mine, which is just 10 kilometers away, we assumed the source of the bauxite to be coming in from mines in Africa, right? So I'm saying that such significant uncertainties must be captured in the report. Of course, you will have the approaches that are being used, like Manojji said, the net asset approach or the income approach or comparables approach, and the methods, right? I will not go into each of these points, but I think it's important to capture the valuer to capture the important procedures that have been performed, the major factors that have been borne in mind, and any weightages between methods and approaches that have been applied by this thing, and the reason behind it, right? Ultimately, the conclusion and the principal reasons for valuation is important to be clearly put down in the report, and capture all the disclaimers and caveats. So that is from the reporting side. So I think I'm done with my session today. Thank you very much. Over to.
Thank you very much, Anilji, for giving a detailed thing related to valuation and different aspects. Now it's time for question answer. As you are aware that we have a system that people can ask questions. So all the delegates, all the participants, they can send me question. Whatever question I have received, I'm just asking. So first question to you, Manoj. Do the right issue by the private limited company requires valuation? All the shareholders are resident and renunciation of shares, if any, will be held among the existing resident shareholders only. The issue
So,
right issue by such company is to be determined based on fair market value or intrinsic value based on some other basis. Your view.
So legally, there is no requirement of carrying a valuation for right issue. Right issue is given, rights are given to everyone. So there is no question of valuation for the purpose of giving the rights. It is given proportionately. However, in case there is a non-resident shareholder, then FEMA requires valuation from the point of view of the non-resident shareholder who are getting shares. So they should get the shares not fair at not less than fair valuation of the share. Similarly, in case of renunciation of shares, there can be a situation under income tax where department can say that the valuation, the shares you are getting is at less than the fair value as per their formula 11 UA rule 11 UA valuation. Then they can question and they can say that this is a discount or gift given to you and that should be taxable. So legally there is no requirement of valuation for the company, but valuation is generally done under income tax in case of renunciation. In case it is totally proportionate, then there is no need, no risk of under income tax also.
Okay. Manoj, now, Anilji, the point is that you do the valuation on plant and machinery.
Yes.
What are the factors you have to see? It's just the replacement value, depreciated value, or some other things?
No, sir. I mean, as I said, you firstly have to look at the purpose of the valuation. The purpose of the valuation is, let's say, firstly, the assumptions and the premises are important. I mean, if the company is a going concern, I would still, even if I'm doing a plant and machinery valuation, I may still use income method. I may also, I also rely on some market methods, right? Cost method is generally what is, what you're talking about, which is the replacement cost method and historical cost using indexation and all that, right? But I'm not bound to use replacement cost and in all situations, right? It's for the valuer to basically judge the most suitable method in that situations. As I said, if it is if it's a piecemeal sale of asset transaction, which is, the purpose of the valuation is that is ultimately is going to be sold as on piecemeal basis, not for the existing use. Then cost-based method is a good method to use, which is replacement cost method and let's say replacement cost method or essentially replacement cost. But if I'm doing a going concern valuation, I would use historical cost only as a comparator. I would only use it as for me to get an idea as to what would it cost for me to build the asset. But I still need to keep in mind what is the earning capability, as Manojji put it in one of his slides, right? The earning capability of the asset is very important, because the rule in economics is that either I will pay what it costs me to replace for the equivalent utility, or what is the economic value for me today in buying that asset. So ultimately I'm buying it for a business. So what is that I'm going to earn in 20 years over the life of the asset, right? And so with the replacement cost is important only from the cost angle, but it's important for me to factor the income side, the income earning capability of the asset also. So I would not restrict in any way using only cost method. Some situations I need to very, I would say, adroitly figure out what is the, what is the best what is the best approach for me to apply in the situation, depending on my experience and my judgment on the purpose of the valuation and the transaction, which is.
Okay. Manoj, is venture capital or scorecard method accepted under Companies Act or FEMA or SEBI? But before this, please tell us what is scorecard method.
So scorecard, as I explained, is a supplement to the startup or early stage companies valuation, where either first Chicago or venture capital method is applied or any other method is applied. So all that valuation is further subjected to various parameters which the investor want to determine, like the industry in which this entity is acting, working, the experience of management, the subjective factors, the patent, etc., etc. There can be hundreds of factors which can have a impact on the valuation or performance of the company. So based on these subjective factors are given certain scores, and the average of those scores are applied to the valuation determined through the financial formula, and that is called the fair valuation of the company. So this is not a separate method, it is a supplement to the existing method. And if we talk about the regulatory aspect, like say we are doing valuation as per SEBI formula or as per income tax formula, that is determination of price as per the formula. So that price may not be the fair price. It is just because of the government prescribed method, we have to carry that, apply that methods, we are applying that methods. So it may not be the fair valuation, and hence question of these methods may not apply.
Okay, Sanchit, how many valuation corporate function has done till today?
So we've been in the valuation industry for the past 12 years now, and we are registered value entities and SEBI registered Category 1 merchant bankers. We've done almost 4,000 plus valuation reports up from the very beginning, and we do almost 200 to 250 valuations on an average every year.
Okay, and what are the industry where you are doing this?
We have served 35 plus industries, almost every we've done we 35 plus industries traditional. We've also done valuation for lots of startups, and startups can't be really categorized into sectors or industry. Technology, fintech, all of these.
Purpose is to ask you, when you are doing multiple valuation, multiple things, and now you are doing some international valuation. So what are the difference you are finding with Indian valuation and international valuation, and what are their expected, the client is expecting from Indian value when the professional of India is doing valuation of international?
Actually, valuation is beyond borders. Anybody who does valuation in India or anybody who does valuation in, let's say, US, their value might be different, but the assumptions, the limitations, or the circumstances in which they both do valuation would differ. But as a valuation professional, we always follow the valuation standards, have certain approaches to be applied to, certain premiums, discount rates to be applied to. That way, anybody can do the valuation, having that credibility to do that. The value may be different, but it doesn't really matter whether we are doing a valuation for a company in US or a company in India. The valuation professional can do the valuation for them.
Okay. Anilji, can you tell us any interesting point which has come in valuation relating to the insolvency? Any interesting facts which has come to your?
Okay, so lots of interesting facts. I mean, we've done. I personally have done valuations of thermal power plants as I said, I mean, I've done 600 megawatt into 2 power plants, and I've done another 600 megawatt into 2 power plant, which is a coastal plant, and both were valued on a very, on a very different major factor were completely different, even though they were thermal power plant. But there's just one single difference between the two, which was this: that one was a domestic coal plant and the other was an imported coal plant, right? So that single factor actually changed the entire economics of the plant, right? Because the imported coal plants have firstly they have slightly different engineering, and they have the cost basis of the cost of raw material. I mean, the cost of producing energy using imported coal is much higher as compared to this thing. So even though they are thermal power plants, you can say your experience, you've done previously many thermal power plants, but then when you come across imported coal thermal power plant, this single factor can actually turn it upside down, and you have to relook at the, even though the nature of the industry is very much the same, the about the general PLFs, which are this thing, and general environmental rules that are being followed, but the single factor can give you a very different, you will have to look at the asset in a very different way.
Okay. Manoj, how do we determine the terminal value growth rate in DCF?
So there are prescribed methods through which certain the terminal value is determined. Basically, the terminal value is the value of the business after the high growth period, when the company's business gets stabilized and there is a consistent growth. So we generally take a consistent growth rate which is near to 4-5%, which can be achieved by any business if their business is getting saturated. So at that price, that valuation is basically capitalized to determine the fair valuation on the terminal date, and then that is taken to the present value through the WACC rate, discount rate at which all the years cash flow is discounted for.
Okay, and is the discount rate usually the WACC or
Yes, weighted average cost of capital is very common method to determine the discount rate. So yes, that is the case. Obviously, I think the question is, if the company has no debt, then what is the weighted average cost of capital? Obviously, there are factors which determine the risk of the industry under which it is working. The expected rate of return for a risk-free rate of return, which is generally taken to be the 10 years government bonds return. So that rate is taken as the risk-free rate of return, and over and above that, there are certain premium which is given based on the industry or various factors involved in the industry for which it is determined. So that is the rate of return, expected rate of return for the equity for any company.
Anilji, on plant and machinery valuation, either on replacement cost or by the historical cost basis, how does be prepared for any tax implication in case they send us a notice?
I think I think this question, I think is stemming from the fact that if you're increasing the value on the balance sheet, right? So will it lead to a tax notice, right? So the better person to answer this is Pawanji, yourself, or maybe Manojji or Sanchit, you. I personally am not a CA, so I don't know how you would handle whether this notice can arise, from not the opposite of impairment, right? So generally the assets would be impaired, but let's say that assets are being valued up for certain reason, then can that arise? Can that lead to this thing? Is that seems to be the underlying question here, right?
I believe that is the question, but practically, unless there is a transaction, there cannot be any tax implication. So if there is a sale or purchase of the assets based on whatever valuation, let's say replacement cost with method, and that is replacement cost is much higher than the book value, then there can be capital gain implication in the hands of the company. So yes, if the transaction is happening, then there can be tax implication merely because the company is revaluing its assets or putting their assets on their fair value. That does not lead to any tax implication.
So the point is, inside your balance sheet, whatever you want to do, you can do. But if you are doing transaction from one entity to another entity, whether it's your own entity also, you have to pay tax.
Yes,
Right?
notional gain is not taxable. Actual gains are taxable.
Sanchit, it is not always that you will find a company working in the same line of our company. In that situation, how will you apply market approach of valuation? Because you are saying peer review, peer comparison, but if this is not available, then what will you do?
So definitely when we are doing a valuation as per the market approach and we have to apply a company comparable methodology, there are almost 80% of the time where we don't find a similar company. In that case, we'll have to appropriate a discount or premium to our target entity as per the company that we have found the closest to our company in terms of the industry or the type of business that they do. The difference could be in terms of the size, probably diversification, the products, even in terms of the business model, the revenue, even margins. So there are cases where companies are different. While doing comparable methodology, we appropriate discounts and premium to our discount rate while doing valuation.
Yes, we can. Sometimes, sir, we if required, if the company is having multiple businesses or there is a combination, and it is not easy to get the peer which is having a similar kind of combination, then we may do breakup value method. We can do the valuation for each division separately, and then sum of part valuation can be applied with certain discounts to determine the fair value of the equity.
What is the strike price in Black-Scholes model?
Strike price is the price at which the options can be converted into underlying assets, which may be generally equity shares.
Okay. In case of land valuation, whether you take government rate or market rate, if market rate, how you decide the same, or sometimes the circle rate is also one of the consideration, and sometimes circle rate is higher and market rate is less, or sometimes market rate is higher, circle rate is less. So what is the call you will take?
So obviously, nobody is here which is representing the land valuation aspect. But generally, for government regulatory purposes, government value is taken as the fair valuation, which is the circle rate. Government rate means circle rate. But otherwise, for transaction purposes, fair valuation is done. And for that, generally the valuer goes and do the survey of the area, find out the similar kind of transaction happened in the nearby vicinity. Then they may apply premium or discount considering the distance from that the place for which they are doing the valuation, from the quality of a structure, etc., etc. Based on that, they may give the fair valuation estimate. But for specific transactions, government rate is used for.
This is another question has come. Can a going concern in IT industry thinks of doing a voluntary valuation and prepare itself for either a GST implication or a IT implication? What are ramifications if the concerned intangible asset is transferred to its subsidiary company? Can Manoj throw some light on this? As I remember that there were notification on the GST aspects. Venkat Raman has asked this question.
I don't think voluntary valuation can have any implication for either GST or for any other purposes. However, and I'm not expert of GST, so I would not be able to give final verdict or final answer on that.
Okay, Anilji, very interesting question has come. Mr. Ajay Nair has asked, suppose we do revaluation of our plant and machine. Can the entity claim a higher depreciation and therefore reduce the tax liability?
Generally, company company valuations, there is a depreciation rate which is defined as per the company law. I mean, there is a schedule which is followed, right? So you cannot change that. It's defined, right? But if you're doing I think there are certain instances under which you can apply a higher rate of depreciation, which is a higher number of shifts that you're doing, or if you're doing, higher number of hours of machine working, then I think there is a possibility. But I think under the company law valuation rules, there is, which is the Ind AS 16, I think, right? Sanchit, would it be possible to claim a higher depreciation? Can you?
So actually, it depends on whether the depreciation that is being revalued, can we claim it on a higher basis or not, whether we justify the depreciation for that respective revaluation. So it has to be checked on that basis.
Yeah.
Manoj,
So
if that is the possibility, so Anilji, you are right. Like asset valuation, you are giving depreciation on the basis of the company law and the prescription. But suppose sometime what is happening, the supply of that machinery is not coming from these the international market, and the value of the machinery has increased. Even you can sell second-hand machinery to somebody if he is asking on a different rate because supply is not there. So I can I do, Manoj? This is not.
So depreciation under income tax is a separate subject for which the rate is prescribed under the tax statute. You cannot apply higher depreciation or lower depreciation from based on your whims and fancy, considering your factors. Yeah. Book value, you can do the adjustment as per Ind AS. You can do the fair valuation and put the difference into the other comprehensive income. But that is not allowed under the income tax. Income tax goes by the cost method only till now.
Okay. No, Manoj, I'm asking something different. Suppose there is a machinery, Anilji, you can also throw light. A machine which has a life of 20 years.
Has a life of 50 years, okay.
20 years.
Right.
Okay. Now, after say 10 years, you are giving depreciation by income tax and by company law. So whatever income tax, whatever depreciation is there. But suddenly there is a closure of the plant where the machine is not coming from international market, and the value of the machine, which is old, of 10 years old machine, it's selling at a say the same price where you have purchased your new machine because the demand is there.
Yeah.
Can I do revaluation? This is number one.
You can do the revaluation, sir. It was very much clear. You can do the revaluation, but it will not have any impact on income tax purposes because income tax talks about the cost of acquisition, cost of improvement, and the depreciation. Whatever depreciation you have charged as per the income tax, that is the block of asset value, and the tax is implied based on the block of asset, not individual assets. So there are plant and machinery is a single head under which certain rate of depreciation is allowed. So you can, whatever is the balance of the block of asset and you are selling that will be adjusted in that block of asset only. So that is the way. It has no impact.
When is adjusted present value method used in practice?
What is, is this adjusted present value method? What is it? There's a present value, net present value used in the terminology is used in this thing in DCF, right? So I don't know what Nitika means by adjusted present value method. So
I think adjusted present value method means after depreciation or after reducing this, there's a adjusted present value.
So net present value is actually a income, jargon, whereas adjusted or adjusted replacement cost or whatever is based on the on a cost basis. So these are two different languages. So they don't.
It is a combination of two different. Yes. So it is not.
The same question on Anilji on revaluation. One cannot claim higher depreciation in income tax. In books, you have a claim higher depreciation.
Yes, that is the answer. Yes.
I mean, we answered this question. I think you have to follow the company law. Company schedule, right? Company law based schedule. You need to follow that. So even, for instance, in a power plant, there is a there is a depreciation which is governed by the electricity authority. Right, so they allow you certain depreciation. They will not allow you more or less for any rate regulation also, for any other purpose also. So they will not permit you that, right?
But you are mute.
Is there any situation where that valuation report is rejected by any authority for any reason?
Yes, it can be rejected. In insolvency cases, we can see that there are many situations where objections are made on the valuation approaches or valuation report of the valuer, and then there has been disciplinary actions against the valuers also.
Yeah, strictly speaking, it is not rejected. Actually, what happens is that there is a huge divergence between the two valuers. So then a third valuer is brought in to see which is the closer one, you know. But really speaking, either of them could be wrong. Either the higher could be wrong or the lower could be wrong. There is no certainty about that, you know. So the divergence in reports is normally is there sometimes, and that leads to higher divergence of 25% or above will lead to a third valuer being appointed in insolvency cases, right?
Yes.
But reports can be strictly, I mean, rejected if there is a logical reason for the client to have seen that, you know, there's no reasoning behind the report, or there is, you know, there is some, it doesn't follow the scope of work, for instance, and that report, I suppose, can be rejected, but that was very rare. I mean.
Last question. In case of DRT auction, if the valuer values very peanuts value where government valuation is 5 times higher, what the company promoter has to do against valuer and DRT? Example, office premises valued at 4,500 per square feet, whereas government valuation is 25,000 per square feet in Mumbai, Borivali. What is the solution?
So this is, I think, he's talking about some surface auction stuff and all that. But I think in that case, I think since the owner is already there in the DRT, right? So he can possibly file an appeal in the DRT, you know, claiming that this report is non-factual or whatever, and he can produce another report. And then, which case DRT will appoint another reviewer of reports. You know, somebody who's who can be called an expert and who will look at the real situation on the ground.
Okay. So now it's a time to end this program. So I thanks everybody. But before going, we have a tradition to ask one last question from everybody. That what is the they think about the valuation concept and valuation practice in India? So any 1 minute, please give your comments. Anilji, I will start with you. You can tell us what are the changes required, some things, and the
So I think currently what is happening is that valuation is being treated more like a commodity by the clients, and I think that needs to change. And I think the reason behind that is that maybe the valuers themselves have not been able to pitch the value of valuation, right? So they need to explain the value of valuation as to how a good valuation can make a huge difference in the transaction, right? So whatever the purpose of the valuation is, if it's not being met, then a few, of 1 lakh or 2 lakh rupees or 50,000 rupees being saved in the valuation report, I think that will not be material, right? So ultimately, I think, the client should not look at the valuation fee. He should look at the valuation quality more, right? And today it is very commoditized, but the new regime, I think, is bringing in very strict principles, and a lot of valuers are being ticked off by the IBBI. Their reports are being scrutinized, which has never happened. Yesterday, 4 reports were uploaded by IBBI. Just to give an example of what the valuers have not been able to, show in the report. So it's time for both sides to actually make sure that quality is good,
Manoj.
Yes, sir. I think it is an evolving practice. As Anil sir was talking, it is very, very important to give importance to the valuation. Valuation should not be just a certificate. It should be a detailed analysis, purpose-based valuation. And there should be a standardization so that it has a worth in for the purpose of for the purpose it is being taken. So that would happen when there are quality people who are doing the valuation, and sufficient remuneration is being given to the valuers, then only they can justify those valuations. So obviously, commoditizing the valuation is not a good option, and it will not help Indian valuation industry to grow international level. So yes, valuation, and it is growing. I believe slowly it will be a separate profession where certain people will do the valuation, and that they will be fully regulated. All regulators would use those valuation valuers only, services of those valuation valuers only. So that time would come very soon, I believe.
Sanchit,
The future of valuation in India looks very promising, definitely, and is expected, I think, to undergo significant changes and advancement in the coming years. I mean, when we talk about increasing demand for valuation services because of the boost of the FDI in India, emphasis on the corporate governance and transparency, integration of the technology and the data analytics will play a significant role in shaping the future, focusing on sustainability and ESG factors, and even continued professional development and regulation. We'll have to follow high standards, as Manoj sir and Anil sir said, that we don't need to commoditize it, and also expansion of valuation services beyond traditional asset. With the growth of the digital economy, intangible asset, we as valuation professionals need to adapt these and emerging asset classes, so and uphold high professional standard to meet the evolving needs of the business, investors, also regulators in India's dynamic economic landscape.
okay. So thank you very much, Anilji, Manoj, Sanchit, for giving this lucid presentation as well as the giving answer of all queries. Friends, thank you all my participants, those who have come, because this is a very technical subject, and the scope is also not that wide. That was a security law and company law, but they have come. Thank you very much to all. Friends, this journey of knowledge sharing will continue. As you are aware that this is our 128th program. We have continuously doing webinars since last 3 years. It's the third year we are completing. On next Friday, we are having on next Friday 4 to 6, we are having a program on discussion on consultative paper on proposed amendment to the definition of UPSI. As you are aware, on 26th we will discuss this. SEBI has come out with consultative paper on various definition of UPSI which they want to modify, they want to extend, and this program we will do, and we have requested SEBI officials, so they will join us and they will give answer of all these queries, and we all will discuss that what are the problems in implementation. So we will call the people from industry, people from regulator side, and you will also be there. So thank you very much all, and see you next Friday on 24th at 4 p.m. See you again.